What can stop this equity rally? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Jared Dillian, editor of the Daily Dirtnap newsletter. Hey, Jared, how are you?
Good. How are you?
I'm doing good. It's Friday before a long holiday weekend, although it's one of those weird ones because July 4th falls on Tuesday. So Monday technically is not a holiday, but
Well, at
like
least
no
it's
one will be working.
at least it's not one of those years where July 4th falls on a Wednesday.
That's even
That just
worse.
ruins everything.
That does. That's even worse. But it's gonna. For all means and purposes, it's a long holiday weekend because there will be like non-existent volume on Monday, and it seems like everybody's going into the weekend feeling pretty upbeat, at least about U.S. equities. We had stocks on track to finish the week with a strong rally. Right now, of course, they're still trading because we're doing this midday, sort of mid-session, but they're gains of 1% across the board. Apple and Meta leading the way. Apple hitting a $3 trillion market cap. What do you make of the market action?
Uh, you know, um, I keep looking for signs that we might be near a top. I guess the title of this is what's going to stop the market, and I guess the answer is nothing in the short term. Um, sentiment is still, it's gotten bullish. I would say it's at least 50% bullish now, but it's not stretched. Gunlock, I want to say about a week ago, said in an interview that stocks are in a mania. They're absolutely not in a mania. This is not a mania. I think there's a lot of enthusiasm for seven stocks in particular, but we're far from where we were in 2021. So, I think the answer is you just got to play along. And this is going to continue for a couple weeks, a month, maybe 2 months, and we'll see.
Yeah. It's interesting because you can kind of feel that people hate it because it's been, so many people saying it's too narrow, it's too concentrated, it's too I've noticed the last couple days the Russell's been trading up higher too. Um,
Yeah, I mean, here's the thing. The S&P 500 is decreasing in usefulness as an index because it's getting so concentrated.
mm,
So Apple and Microsoft make up 14.4% of the index, and Apple's about 8% of the index. Apple at a 3 trillion market cap is bigger than five sectors. Apple alone is bigger than five S&P sectors. So the S&P 500 really is just turned into, it's five or seven stocks that make up like 30 or 35% of the market cap. And I think really, it would not surprise me if this continues, if money managers start changing their benchmarks
mm.
to the equal weight S&P or the Russell 1000 or something like that, to something that's a little bit more broad based.
That's so interesting. I always think we have to remember all of those dynamics. Anytime we talk about the benchmarking and managers, I always think of Mike Green because he has so many opinions about passive investing. But when you're saying that, it sort of reminds me, and I think you probably touched on this in one of your newsletters. We're also coming up to the end of the quarter, the end of the half. It's not just the end of the week. So there are a lot of people who weren't in some of these tech names who are playing catch up, people who hate the rally, think there's too much froth around AI, but you look at some of these names and if you sold out earlier, you're behind, right? Like how does that whole dynamic play into it?
Yeah, I mean, I think if you're, let's just say, a growth manager at XYZ mutual fund, and you have to own Microsoft. Like if Microsoft is 7% of your benchmark, like if it's 5% of your fund, you're behind, right? So it turns into like this reflexive, like self-reinforcing process where people, you get that concentrated performance in the index, and people have to chase it higher, or else they're just going to be behind. So
That never ends well though, does it? Because that's when we start to get into, especially if you get retail sucked into that. And I think they know that, right? I think that's why there's so much skepticism because they're like, hang on, I don't want to be the one buying at the top here. I mean, does it feel there's two questions. I was going to ask you for overextended on tech, but that's not really, that doesn't make any sense to ask that. What you want to know is if you own it, should you sell it? Like if you have shares in this, And do you certainly not buy it here probably, you know?
Well, I don't think you should sell it here, but let's think about this for a minute. So, the biggest stock in terms of market cap in 1980 was IBM. And as of 1987, IBM was no longer the biggest stock in terms of market cap. So I think Apple is kind of in the same place that IBM was in 1980. And if you were to ask me, like, what are going to be the biggest stocks in 2030, I would say probably not Apple, probably not Microsoft. It'll probably be something else. I mean, it will decline in terms of relative performance over time. And the thing with Apple is, I remember it wasn't that long ago. It was about 10 years ago when Apple was a pretty cheap stock. It was trading at like 10 or 12 times.
Yes, it
And
was.
a lot of this, increase in market cap has been valuation expansion. So I
Mm.
haven't looked at it in a while. The last time I looked at it, it was trading at like 35 times earnings. But I don't see where the growth is coming from. Like everybody who's going to own an iPhone already owns an iPhone. Maybe it's from the headsets. I don't know. But I don't see where the growth comes from. So I don't really want to pay 35 times earnings for a $3 trillion company. Like it just kind of doesn't make any sense.
Yeah. And we were talking about to Brent Donnelly yesterday, who was bringing up the same point about NVIDIA, which he said he kind of hates, but it's not because of anything the company actually does. It's just that when you look at the math, in order to justify the kind of valuation, it just gets impossible,
Yeah.
at least from his perspective. So it's tricky, but a lot of people felt like that $100 ago. That's the problem, right? And yet here we are. So it's tough. What what about the kind of reverse is happening with energy? So, this is a conversation that comes up all the time, right? Is tech overextended? Are we too bearish on energy? Because there are two of them are diametrically opposed right now. How are you
Well,
feeling about the energy complex
you
from an
know,
equity point of view?
I'm the sentiment guy, and I think we got a big sentiment data point with energy. Pierre Andurand, who I don't really know, his fund was down 50%. His energy fund was down 50%. So when you start seeing, you know, big names in the space being down 50%, like being long oil, like we're pretty close to the lows. So one of the things that I've been thinking about recently, you know, we kind of have this quant factor regime where tech rallies every day and energy sells off every day, and that outperformance just gets bigger and bigger. What you really need is some kind of exogenous event where you have a piece of data or something happens that catches the quants off sides, and then you have a big reversal. So we have payrolls coming up next Friday,
Mm.
and the last I looked, expectations were for 200,000 jobs, which is pretty low. But I can tell you that if we miss expectations for the first time in 15 months, you're going to see a big reversal in these factors. You'll probably see tech down quite a bit, but that's just speculation. So
Why would that
payroll,
happen though? Why would you have that reaction?
um, it's kind of like the CPI number a couple of months ago, where 2 year notes rallied like 60 basis points in 2 days, caught everybody off sides. Like, it's kind of hard to explain why it happens,
But
but
why energy? Because I'm thinking, like, if you try to think, we'll probably get questions about this. If we miss and the economy looks weak, doesn't that back the Fed off? But which makes sense for some things. But if you have a less aggressive Fed, I would think that.
from a fundamental standpoint, it doesn't make any sense. But what it forces people to do is close out their positions and go there. Are we getting questions? Are people like questioning me on this?
No, no, I'm just trying to no, I'm trying to just make sense of it myself because this is what sometimes gets confusing because we try to like rationally think this out, right? So the rational, if I saw that headline, I think, oh, maybe people think the Fed won't have to hike rates or hike them consecutively because Jay Powell's been, flapping around as hawkish as he can this week at that central bank forum saying maybe two consecutive now hikes. We're not done. So if we have a bad payroll number, then maybe people think, well, maybe they don't have to be so hawkish, which I would think would be okay for tech. and equities. But I don't know why oil rallies
It
on
would it
that
would be
because
so it would cause rates to go down significantly. So 10-year rates would go down like 20 basis points. The dollar would weaken, which would be bullish for commodities.
okay, thank you. That's the bit we need. So this
Yeah.
is why currencies matter so much and we don't always talk about them because if you're just looking at the interest rate function, that's fine. You can make that make sense because that would be the demand side of commodity, the demand for oil. But oil's already low, already thinks demand stinks. So then you get the currency side, which is new and would move it, which
Yeah.
is it's always a sort of multi-dimensional puzzle, which is why when we have folks like you on Real Vision, we're diving into currencies, to commodities, and trying to look at this on a three-dimensional level. So thank you for that. Um, Jared, that makes a lot of sense. And it's what people don't expect to your point, right? Which is why I know you're paying attention to sentiment. It's a thing that's new that wasn't sort of on the radar or in line with expectations.
Yeah, I mean, I think that after 14 beats in payrolls in a row, I think people probably expect another beat in payrolls, you know. So we've had two claims numbers this month that were worse, 260, 270, something like that. And that's why I think the estimates are low. I don't think payrolls need to miss by a lot. I think even if they come in like 180, 190, it's going to set off the reversal.
Yeah. That's interesting. It would also be really out of step with everything else we're hearing about the economy, right? Because we've been hearing that not only are things resilient is the word everyone's using, but a couple of people pointed out this week, it looks like things are reaccelerating in some places, including housing.
Yeah, I mean, housing is kind of its own story. Basically, there's what happened was rates went up, and you have a lot of people who have 2.5, 3.5% mortgages, and they're like, I can't move because if I were to buy a new house, I would have a 6.5% mortgage, and I wouldn't be able to
Yeah.
afford the payment. So nobody's moving, and there's no inventory. I think we have the lowest inventory of houses for sale in a really long time, like 10 or 20 years. So prices keep going up. I mean, even in my neighborhood currently, which is probably about two or 300 houses, there's not one house for sale. There's been two transactions in the last couple of months, and they sold in 24 hours.
Mm. Well, you do live in a hot area, but I get your point. There's
Yeah.
no movement, which there always is, especially in the States. I think that's a um, it's not the case everywhere in the world, but certainly in the States, people move and pick up for jobs, and there traditionally has been a lot of labor mobility and just general mobility. People don't think anything of moving across the country, which is not always the case everywhere. So that would be that a weaker or slightly weaker jobs number would kind of be out of step with a lot of other things that we're hearing. When we're talking about energy, does it? So was asking whether tech feels like it's kind of getting toppy or overextended. Should people sell? Sort of same question for energy. You mentioned that Pierre Onderon's fund is down. He's somebody who's been on Real Vision. We'll have to, if he'll talk right now. It's hard to talk when there's pain, but maybe we'll try to get him back on. Um, is it time to start nibbling at energy? Are you looking at it, or do you need to see more confirmation? Do you still see downside?
No, I don't. I think that now is a good time to be accumulating a position. I think the downside is very limited. For one big reason is because there's always that persistent threat that the government's going to start re-adding to the SPR,
Mm.
which they said is around this level, around $70 in oil. So we seem to have found a floor in the price of oil. So you really have like a great low risk setup to just sort of nibble at a position, just accumulate it over time, and yeah, hopefully it works.
I mentioned Jay Powell before, and that central bankers, all of the central bankers were on stage this week talking. We've been talking about it all week because there was a lot of headlines that came out from it. Do you sort of buy what Jay Powell's saying that they're going to have to be aggressive? Do you think he's just jawboning and they're really going to just look at the data that comes in Does it
So
worry you? How are you thinking about that?
I have a lot of thoughts about this.
Share them. Share them, Jared.
So I think that the Fed has lost sight of its inflation mandate. And what I mean by that is, the last CPI reading was 4, but if you look at some of the private real-time measures, we're into the 2s. So inflation is really into, it's 2.4% if you look at Trueflation, which I trust. And if you think about this, they're threatening to take Fed funds up to 5.75 or 6%. If you have 2% inflation and 6% Fed funds, you have 4% positive real rates, which is overly restrictive. It's massively restrictive. 4% positive real rates is nuts. It's just as nuts as the negative real rates that we had throughout the 2010s. When you have interest rates that are out of equilibrium, what happens is it causes misallocations of capital. Okay. So in the 2010s, we had a massive misallocation of capital into housing, into tech, into crypto, stuff like that. And now we're having a misallocation of capital into CDs, into money market funds, into T-bills. That's the consequence of this monetary policy. And I think what they've done is they're focusing on the labor market to the exclusion of everything else. They think that they can't stop inflation until the labor market weakens. My guess is you could get inflation down to 2%. And if unemployment is still 3.7, they're still going to be raising rates. I don't even think they care about inflation anymore. I literally just think they're trying to get people to lose jobs.
Which would be bizarre since
Yeah.
that's kind of their other their other mandate. Is full employment, price stability and full employment. We know that there's no an absolute on what that level is. So do you think they're backward looking with inflation? They're looking at the wrong gauges. Why do they think inflation? Because he's been very clear inflation is still running too hot.
It's really not, though. That's the thing. It's weird. Like the CPI is lagging, right? And they know this. Like the next reading in CPI is going to be in the 3s. It's going to be in the mid to low 3s. We're getting pretty close to the target. They're making the same error that they did 4 or 5 years ago when inflation was below the target. CPI was at 1.7%, and they said, we're going to keep doing quantitative easing until we get it to 2%. They have this obsessive focus on the target, the 2% target. Mm. And it's okay to be close to the target, right? But for some reason, they're just super focused on it.
Yeah. I like the way you talked about the misallocation of capital. And when that happens, there's usually bad consequences from that. So we saw what happened when everyone was piling into, casino-like activity. And then when that reverses, whether it's meme stocks or, crypto, wherever you were seeing it, no judgment on those underlying, by the way, we're just talking about the crazy money. What happens when there's a misallocation into money markets? What's the negative consequence of that?
Well, the consequence is that you have 3,000 bank CEOs like every day that are watching their net interest margin on a daily basis. You know what I mean? Like, and it gets worse and worse and worse. So that's hurts
the banking system. It's causing that bank walk that Bianco and others talk about.
And I think the last time I was on, I talked about this concept of the pig passing through the python. You remember that?
Yes, I do.
So, but
your lovely visual.
I would be
as we
surprised.
All maybe eat lunch.
I would be surprised if they do get Fed funds up 2 more times. I'd be surprised if they get 2 more rate hikes. But if they do, 100% you're going to see more bank failures, without a doubt. Absolutely, without a doubt. No doubt in my mind.
And the Fed's taken this stance, like I'm paraphrasing, like it's not really our problem. It's like bank mismanagement, interest rate mismanagement. It's not really our problem, which I find interesting. But as long as they're not systemic, I guess you'll just see consolidation.
Yeah, it's forcing consolidation is what it's doing. Yeah.
Jared has a skeptical look on his face because it's the famous last word of any central banker is that's not for me to worry about before all hell breaks loose. And so on that point, JP Morgan today reversing their bullish call on treasuries. We have had a couple of things happening. We've had everyone pushing out their recession forecast, and then people capitulating basically on their bond bull calls, just like or just not sure. There's uncertainty about what's happening. We had a question. Let me see if I can find it.
Oh, did you say that JP Morgan
Pivots. JP ditched its bullish view on treasuries. They're now unwinding their long position in 5-year notes, saying they can no longer justify their long duration view.
That's awesome. I love to hear that.
Why?
To hear that. Oh, I'm bullish on bonds. Absolutely. Yeah.
Why?
Because I think the data. Look at the data we had today. I'm going to look over at my screen. I'm going to pull it up. So Chicago PMI missed massively again for the second month in a row.
But what about people who say that's the good side of the economy? That is in recession, but the rest of the economy is not, and we're 2/3 services.
Yeah, but even the services PMI is coming. I don't remember the last reading, but I think the services PMI is below 50 now. So,
and the PCE today was out as well, and that was 0.3, down from 0.4 in the previous month. The yearly change, it's edging down. It's not.
Yeah.
It's not falling like a rock, but it is moving in that direction slowly. But Peter asking, any way you would play the inverted curve 2-year, 10-year?
Yeah, there's a bunch of ways to do it. The cleanest and simplest way to do it is with eyeball, which I own. I own eyeball. It's basically a curve steepening ETF.
Nancy Davis,
yeah,
quadratic, right? Yeah, we've had. For those of you who are members, we had Nancy on, which was the timing. I'm going to say was more luck because we admire Nancy's work, more luck than anything else. But it literally was right before the bond volatility blow up. But in that, she just lays out her thinking and, importantly, how you can use derivatives as a tool to handle this kind of stuff. So you can go track that down on the website if for those of you who have not had a chance to look at that. I can't remember. It was a couple of months ago, but if you search up her name on the website, it'll come up, as well as our fabulous My Life in 4 Trades, which if you haven't watched, you should. Nancy is amazing and she has a great story. Anyway, so IVOL is one way to play it, Jared.
Yeah, and if you want to do it with lots and lots of leverage, you can do it in futures. You can do it with 2-year note futures and 10-year note futures. So you're basically buying 2s and selling 10s, and you have to get the ratio right. I don't know the ratio off the top of my head, but you have to duration weight it so you don't have any net duration on the trade. How else can you do it? There used to be a couple of Barclays used to have a couple of ETNs for the curve, but they were 10-year notes, and I think they rolled off, and I don't think they exist anymore. But really, the cleanest way to do it is with eyeball.
Yeah. You can go to Quadratic and look at that, their website as well, to understand a little bit more on how that works. And by the way, and if anyone has any daughters or nieces or granddaughters who are thinking about a career in finance, you have to have them listen to that podcast because she's a real sort of pioneer. And there's some funny stories about her, her voyage into the world of derivatives,
Well,
which is not.
She spoke at my conference.
Oh, she did?
Yeah.
She's fantastic, but really accessible too, because derivatives can sort of be intimidating for people. And I think Nancy really sort of talks about it in a way that you can understand. This is a really interesting question. Mike, maybe Jared understands it a little bit more than me. I'm not sure I understand this question, but Mike asking, does Jared think Apple might be the new TLT and NVIDIA might be the next Apple? Do you understand that?
Not really.
Okay, no. Mike, you're on the platform. Give us a little bit more color around what you're getting at there. I'm guessing it's like a sentiment, like is I don't know. Yeah, fill us in. Tell us exactly what you mean by that. So I wanted to ask you about something else. Christopher's asking, is Jared's new house finished yet? Got to slip that one in there.
Not only is it not finished, they pushed back the estimate for completion today. So it was supposed to be done in December, and they pushed it back to February. So it actually got pushed back today. So
That's a gut punch.
yeah, I kind of
Maybe a sign of
expected that.
labor shortage. We talk about, for those of you who are not on the platform and are newer to the show, we talk about Jared's House because in many ways it's an economic indicator that we track
Yeah.
for the Mid Atlantic region, whether it's lumber costs or labor shortages, which is what I'm going to blame on this next delay, because we can't really blame supply that much anymore. So I'm going with labor. Jared, wanted to ask you about this headline that came over on the Supreme Court ruling on student loans. So the Supreme Court in the U.S. here, if for anyone who's global, struck down student loan forgiveness the Biden administration had passed as part of COVID. So anyone who did not have to pay back their student loans or there was a moratorium on it while this made its way through the courts is going to have to start payments again in the fall. Does that sound like it's going to be a drag on the economy, or kind of hard to determine what that looks like, Jared?
Uh, I think you have to distinguish between something being a drag or not being a stimulus. I think
Mm.
I think if it did pass and you did, I mean the forgiveness was about 400 billion. I mean that would be like 400 billion being pumped right into the economy, and I don't think anybody was operating under that assumption. So, I'm going to say it's not a drag. It's definitely not a drag. But what's happening is that I don't know the exact date, but this payments are going to start up again on student loans after being halted for 3 years, and that is going to be a drag on the economy for sure.
Mm.
So
Maybe on some sectors more than others. I like the way you're looking at it though, like less stimulative. And so if it's not an overall hit, maybe it's going to be more concentrated where that if we want to call it disposable income or that extra income for young workers would have been spent. So maybe it would be worth us investigating it from a more sector perspective as we watch that happen.
yeah.
Um, Jared, commercial real estate. So, Christopher noting if more banks fail, then the Fed has permission to reinflate without being criticized. More cowbell. That may be true, Christopher. But they'd also roll the tape on Jerome Powell saying a million times that the banks are fine. So I'm not sure they win that PR fight. But commercial real estate. So we talked about regional banks. If they continue to hike, we will see more bank failures. Maybe more consolidation. Not clear whether it is systemic or not. Commercial real estate. Um, this is, gosh, a source of worry. And a lot of people still feel like it's this kind of like slow rolling car crash that we haven't even seen the worst of it yet. Is that an area that concerns you? Or are you looking at from a sentiment point of view and saying too many people are talking about that?
No, too many people are talking about it. Like if you look at the cover of Bloomberg Business Week this week, it's that scene from The Shining with like the two little girls at the end of the hall, and the title is "Commercial Real Estate is Getting Scary."
Mm.
And I'm like, okay, they just put in the bottom. And this week, you also had SL Green, which is one of the holdings in my portfolio. They sold 245 Park. They sold basically half of it and it was appraised at 2 billion, which shows that the real estate market for offices is liquid. There are buyers. And like this whole narrative about how nobody's ever coming back to work, this work from home is gonna continue, and it's nonsense. Like we're all gonna be back to work 5 days a week within the next couple of years. Like this
Oh, we
office.
got to get you and Jim Bianco talking, because Jim Bianco is definitely on the other side of that.
Well, he was also on the other side of my bullish call when the S&P was at 3,500.
Which is why we appreciate a diversity of opinion and why you're all friends. But this is a really, okay, so that's super interesting. You think that, and this is a really important unknown, right? It's just an unknown. We don't know on the other side. You're guessing and he's guessing that we're all going to be back. Why do you feel that way?
There's points in time when employees have leverage and there's points in time when employers have leverage, right? So now, like at this particular moment in time, the economy is strong, unemployment is low. If an employer says to its workforce, you have to come back 5 days a week, then 20% of them are going to quit and they're just going to do whatever and just, they're going to do something else. But if we have a recession and unemployment is 5 or 6%, if employers say to their workforce, you have to come back 5 days a week, they don't have any choice because they're going to get fired if they don't. So it all depends on the state of the economy
Mm.
and where unemployment is and who has leverage in the relationship.
That's a super interesting way to look at it. I guess the other thing we have to factor in is companies want their employees back in now because they're sitting on empty real estate. But if they get out of those leases, do they care if as many people are working in the office? Maybe the answer is yes for other reasons.
I think they care anyway, just because it's just kind of an open secret that when people work from home, I mean, maybe you and me are the exceptions, but
Thank you for saying that, Jared. While my boss is maybe listening to this, damn you.
A lot of people
Actually happen to be not only more productive but work more because if you live in the New York area, your commuting time is just wasted dead time.
Yeah.
And I just think you end up working during that time. You can work mobily, but it means it's a big pain in the neck. So I would argue in certain areas that I don't buy the productivity thing, but I know what you're saying in other places. Also depends on your age, right? And your like role and all of that kind of stuff. But you think they think maybe that people are less productive.
Yeah, that's what I was trying to say.
Yeah. I had to save myself there, Jared. Interrupt you and save myself. But yeah, and also young people training. That's another like and sort of cultural organization. I think that's something that companies are struggling with. They don't know the answer, but that they feel that that's a pain point in the work from home. So to sort of wrap it, are you bullish on commercial real estate or you just don't
Yeah,
believe
bullish.
doomsayers?
Bullish.
You're bullish.
Yeah.
Bullish like putting money to work or bullish waiting for the moment?
So so you know that while the house is being built, I'm not really
Yes,
trading.
your paper,
So
right.
SL Green I put in the paper portfolio, and I'm sorry that I did because it's up about 30% since I put it in the paper portfolio, not including dividends, and the dividends are 16% a year. So, but if you think about how sentiment was on that stock, this is a stock that pays a 16% dividend that had a 20% short interest. And 20% short interest with a 16% dividend. What are people thinking? So
You got to get that house done so you can get it off the
I
paper
know.
back in the
Yeah.
and back in the actual portfolio. Jared, always so fun to spend the daily briefing with you, but especially on a summer Friday. We appreciate it.
Thank you.
Thanks to all of you as well. Have a fantastic holiday weekend. Just a programming note. We are live back for regular business on Wednesday, the 5th, but we have a really special program for you. We're unlocking stuff for you to look at a couple of different things. And I believe the chats will be open. So I hope you'll view it. If not live, you can certainly view it at your leisure. Crypto Daily Briefing will be live. I'm actually doing that. But the daily briefing is going to be some really, really great premium content so that you can all get a sense of the amazing conversations we have on the platform. So enjoy your long holiday weekend. Take care and good luck out there.